Right now, there is an 87-year-old man sitting in Boston. He isn't on financial television every single day. He doesn't have a viral social media account, and he certainly isn't trying to sell you an online course. But when this man speaks, the loudest rooms on Wall Street go absolutely quiet, and they listen. We're unpacking why in today's Explainer. His name is Jeremy Grantham, and as we'll see, his historical accuracy has essentially forced the entire financial world to pay attention, and right now, he is issuing the biggest warning of his entire 60-year career. Don't own U.S. stocks. Just 4 words. Honestly, it's incredibly rare to hear someone of his level speak in such absolute terms. He isn't saying, hey, be cautious, or maybe hedge your bets. No, he is issuing this stark, chilling directive. And that instantly raises the stakes for everyday investors, you and me, who have our hard-earned retirement accounts tied up in the American market. So, that brings us to the absolute core of this explainer. Why is the guy who perfectly called the devastating dot-com crash in 2000 and the brutal housing collapse in 2008 suddenly sounding the most alarming warning he's ever given? Like, what exactly is he seeing in the data right now that the rest of the market is just enthusiastically ignoring? Section 1, The Prophet of Wall Street. A man with a $165 billion track record. Look, to really take this warning seriously, we've got to look at his credentials. Jeremy Grantham co-founded GMO. It's a Boston-based investment firm that, at its absolute peak, managed over $165 billion. That is a staggering amount of capital, and it represents an incredible level of institutional trust. He's not just a commentator, he has literally steered massive amounts of global wealth. And his timeline of calls, it's honestly almost uncomfortable to think about because of how spot on it is. In 1989, he called the Japan bubble. That crash was so historically severe it took the Japanese market 35 years just to fully recover. Then, in the late 90s, when everyone was getting rich on the dot-com boom, Grantham told his clients to get out. People called him crazy. His firm actually lost clients over it. But 2 years later, the Nasdaq collapsed, falling a brutal 82%. The people who listened to him, they were saved. He did the exact same thing in 2007, right before the housing collapse. So when we hit his 2026 warning, it carries the massive weight of a guy who's been right when it mattered the absolute most. Section 2, the most expensive market ever, entering the danger zone. During a June 2026 appearance on CNBC's Squawk Box, Grantham didn't just casually say the U.S. market is expensive right now. He said it is the most expensive stock market in American history, not just since 2000. Ever. So how's he measuring that? He relies heavily on the Buffett Indicator, named after Warren Buffett himself. It just takes the total value of all U.S. stocks and compares it to the size of the entire U.S. economy. Now, Buffett has famously noted that when this number hits 200%, you are playing with fire. Right now, it is sitting at a blazing 235%. We're way past playing with fire here. We are literally sitting inside the furnace. To put that 235% into real-world terms, imagine a local bakery down the street. It makes $100,000 a year in sales. If you buy that bakery for $235,000, okay, that's reasonable. It makes solid business sense. But if someone tries to buy that exact same bakery for $2.35 million, purely hoping that one day it'll be the biggest bakery on the planet, that's delusional. The numbers completely stop making sense. And according to Grantham, that delusional bakery scenario is pretty much the situation with the entire U.S. stock market right now. So what's actually driving this massive disconnect? It is the artificial intelligence catalyst. Over the past few years, AI has just sent tech stocks into an absolute frenzy. Just think about the numbers. NVIDIA is up over 1,000% since ChatGPT launched in 2022. SpaceX has hit a mind-bending $2 trillion private valuation. Now, here's the kicker. Grantham actually believes AI is a real, genuinely transformative technology. He's not denying the innovation at all. But he argues that the market prices surrounding it have skyrocketed way beyond what current economic reality can actually support. Investors are betting trillions on a future that just hasn't fully arrived yet. Section 3, History's Expensive AI Lesson. Real ideas, fake valuations. You see, history tells us that every great bubble forms around a genuinely exciting idea. But having a good idea does absolutely nothing to protect you from disastrous pricing and financial ruin. Back in the 1840s, railroads were real, right? They completely changed the world. But early investors poured money in at totally unjustified prices, and they got wiped out when the bubble burst. In 1989 Japan, the market was so ridiculously hot that the land under the Imperial Palace in Tokyo was valued higher than the entire state of California. And the internet in 2000? Again, changed everything, but the valuations just detached from reality. Amazon is one of the greatest companies ever built, and yet its stock plummeted 92% from its peak. If you bought Amazon at the top in 1999, you had to wait over a decade just to break even. The takeaway here? Real ideas do not justify fake valuations.
And here's what Grantham's warning actually means for the math of your own life. He estimates the market today trades at about 35 to 40 times earnings. That means you are paying up to $40 for every single dollar of corporate profit. That puts us roughly right back in the same danger zone as a 2000 peak. But he actually thinks the setup today is worse because AI enthusiasm has infected pretty much every sector. His forecast? A decline closer to 70% than 50%. So think about this. If you have $10,000 invested in a standard U.S. index fund today, a 70% decline drops your money down to just $3,000. It is a staggering potential loss of wealth.
Section 4. The perma-bear pushback. Is he wrong this time? Now, in this explainer, we always look at the data from all angles, so let's examine the counter-arguments, because definitely not everyone on Wall Street agrees with his assessment. This is really the core debate right now. On one side, you've got Grantham arguing the market is trading at 35 to 40 times earnings based mostly on hype. But pushing back, you have heavyweights like Federal Reserve Chair Jerome Powell. Powell argues you just can't compare today to the year 2000. Why? Well, unlike those dot-com companies that were running on pure hope and literally zero profits, today's biggest tech giants are actually generating massive, very real cash flows and earnings. They aren't shell companies, they are absolute financial juggernauts. It's also really important to acknowledge Grantham's overall reputation. He is widely known on Wall Street as a perma-bear, basically an investor who is almost perpetually pessimistic about the markets. He warned of crashes in 2014, again in 2017, and yet again in 2021. And in all those instances, the market just kept going up. Even he admits that he doesn't know exactly when a crash will happen. His window is anywhere from 2 weeks to 2 years. Because exact timing in the stock market, it's impossible. Even a profit can be early. Section 5. Protecting your money. The action plan. But whether he's early or right on time, how do we take these big macroeconomic concepts and actually turn them into an actionable plan to protect your money? Well, here is Grantham's specific survival guide. First up, diversify heavily out of U.S. stocks. Do not keep all your eggs in the American basket. Second, take a hard look at emerging markets. He argues they are significantly cheaper right now relative to their earnings. And third, move capital into real, tangible assets. We're talking gold, real estate, commodities. Historically, when abstract stock valuations collapse, tangible items that hold intrinsic, physical value tend to weather the storm so much better. And the data is actually already backing up his advice. Think about the 12 months leading up to mid-2026. While everyone was obsessing over the U.S. market, the S&P 500 gained a very respectable 25%. But emerging markets, they returned roughly 65% in that exact same period. The cheaper non-U.S. markets have actually been dramatically outperforming the S&P 500 recently. So diversification isn't just about playing it safe right now, it's also where the real growth has been hiding. Which brings us to perhaps his most cynical yet totally vital warning. Grantham explicitly states, do not expect your financial advisor to tell you any of this. Why? Because the financial industry has a built-in structural incentive to keep you fully invested in the U.S. market. Telling you to pull your money out literally costs them fees and business. He points out that this has been true before every single major crash since 1929. The industry is just going to quietly ride the wave right alongside you, and they will stay completely silent until it is far, far too late. And that leaves us with this final, intensely personal question. We really don't know if Grantham is right this time. The market could soar for another 2 years, or it could start dropping next Tuesday. But great investors don't try to perfectly predict the future. They ensure they can survive it. So take a hard look at your own portfolio. Look at your savings. If the market dropped 50% tomorrow, would you be okay? If the answer is no, it might just be time to take the $1,650 billion man's advice. Not as a guaranteed prophecy of doom, but as a brilliant reminder to diversify and protect what you've built. That wraps up our explainer for today. Keep questioning the consensus, and we'll see you next time.